Hi, everyone. So we don't have a ton of time, so we're just going to kind of get right into it. I'm joined by Jen and Brooks. Jen from GeoWealth, and Brooks is from InvestNet. And I want to start this off by giving a little history lesson, I think, to bring us up to speed to where we are. I think of the evolution of investing products and services for advisors goes something like this, where we started off with index funds in the 1970s. The 1990s brought us ETFs. The 2010s, we had robo-advisors and then zero-cost trading. And I think that all of those things that came before kind of led us to the 2020s, which I think is the decade of customization for advisors and clients. I was speaking at one of the ETF conferences last year, and a lot of the ETF specialists kind of poo-poo the idea of direct indexing. They don't really get it. They think, well, why would you need to do this other thing if you can just buy an ETF and it's simple? We've been using direct indexing with our clients for a number of years now, and it's a kind of a light bulb moment. But for those people who don't have that customization for their clients, Jen, maybe I'll start with you. What is the pitch? Because I think a lot of people still don't really get it.
Start with Jen.
So I'm going to start by defining customization, because I think there's a wide range here. So you've got customization could be taxes, which would be direct indexing, individual fixed income. Customization could be liquidity, so public and private markets. And customization, really what we're talking about right now, is direct indexing, but we'll talk more broadly about it. I think the pitch is, we've been trying to crack. I've been in the wealth management industry for 18 years, and we've been trying to crack custom for the entire time I've been in the industry. And I think you've had custom, so you've got the growth of model solutions, right, and the growth of direct indexing, but there's still a big part of the market, the RIA market, that is painstakingly doing custom solutions, right? And they might have some direct indexing, but everything's kind of all around the place. And I think the today solution is being able to do everything in one. So it's the direct indexing for your taxes, it's the individual fixed income for your taxes, it's the public and private markets for your liquidity, but it's doing it in an efficient way, the way that direct indexing in and of itself and the way that models in and of themselves have made these solutions scalable for clients. So it's about doing custom, but doing custom efficiently at scale.
So Brooks, what is the selling point to the client? Like, why would a client want to use something like direct indexing?
Yeah, so the benefits, direct indexing, owning the individual securities. So Ben, to your point about the ETF industry, there's benefits to ETFs, as we all know. We all use them in client portfolios, and it's a great wrapper in terms of for a multitude of reasons. But one of the biggest benefits, direct indexing, owning the individual securities, having all those line items, having all those individual tax lots within there, whether it's 100 securities, 200, 300, whatever you're trying to replicate in that direct indexing solution. So now, having to own those individual securities, you can better tax loss harvest, customize as well. And I think maybe to the end client, maybe they don't know, like, hey, I don't want to own XYZ stock security. You don't have to sell them on that. Say, I can actually provide that value for you through this solution. Call it whatever you want, but Ben, where you sit, like you can talk around that without mentioning direct indexing. You could just say, I can do that. I can do that easily through and you're going to do that likely through a direct indexing solution.
I think one of the hard parts about direct indexing and customization in general is that it's not as easy to explain as an index fund. You own the market. An ETF, you own the market in a tax-efficient way. There is a lot more explaining needed. And the cool thing for us is that when our advisors take clients through it, we can see the light bulb going off. And we had one client, when they first were introduced to it and had no idea what it was, say, well, why doesn't everyone do this? But I think it's a little bit of a harder sell. So, Jen, I mean, especially when you're owning all these stocks now. It's not just one fund or 3 funds or 10 funds. It's hundreds or thousands of securities. So what is the right way to communicate that value add to clients?
I think it's about showing the outcomes, right? So you really do see a tax benefit when you do direct indexing, and the ability to report on that and to show clients, particularly in these uncertain markets. I think today we've got clients looking for, what can I do to make money in these markets, or what can I do? And tax alpha is a real thing. So if markets go down, there's a silver lining. If your investments are going down, how can you show that you save money in taxes? So I think in this type of uncertain environment, it becomes really appealing. And how you can do that is with reporting and showing clients the outcome.
And I'd add to that, any of us can go buy any low-cost passive ETF, give similar exposure, but I think as I call it, kind of brokerage statement enhancement to the end client, they see what they own, the transparency, the level of transparency, they see the tickers, they see the holdings, they see the cost basis, they see if there's a dividend being paid by Apple this quarter, next quarter, Microsoft, whatever it may be. And back to Jen's point on the transparency of the reporting. Now you can see reporting at different levels of the individual sleeves that you may own, the individual tickers within there. So I think the transparency, I think end clients like that, prefer that. But Ben, I turn that back to you. Is it too much transparency? I mean, is it easier just to own a ticker?
We had some advisors when we first implemented direct indexing who were very concerned. My client is going to see all these holdings. They're going to get a statement and look at it and see all of this. And yeah, so there's some more hand holding. I think that's true on the technology side as well. Like the technology allows advisors to now do this direct indexing and have more customization, but it's not the kind of thing that you can just set it and forget it, right? It requires far more heavy lifting from the advisor up front explaining it, and also along the way knowing their client. So Brooks, maybe you can talk about how the advisor fits in with the technology and how that relationship works over time when you're implementing these custom strategies.
Yeah, I mean, what we see, at least on the InvestNet platform and how advisors are using direct indexing, two core parts. One, traditional SMA, so using one account and one direct indexing solution. So that's great, that's very successful. But where we see bigger adoption, where we saw growth the last couple of years is within our UMA program. So those that use a UMA, you can use multiple equity sleeves, multiple mutual funds, ETFs, all within one brokerage account. So one client statement. And you can use the direct indexing as the core element in there, or maybe a couple pieces of the direct indexing. So you're seeing advisors use direct indexing for the personalization and customization, but you're not seeing it just on non-qualified accounts. We have 20% of the accounts that are using direct indexing are actually in qualified accounts. They just want low-cost passive beta, and they want to own it in a separately managed account, and it's U.S. large cap core equity, right? So.
Yeah, I think making sure that your technology platform, like ours do, has UMA capabilities does take away some of that extra upfront work explaining it. Because if you've got it in a UMA, it's in one account, and you've got the direct indexing as a sleeve, you can report on that. So you can say your direct indexing sleeve has done XYZ, the same thing that an ETF would do. So making sure that your technology platform allows you to not just sleeve it out and keep it in the same account, but also do reporting on there, so that when you go into the custodial account, you're not just seeing like a laundry list of items and stocks and ETFs and everything mixed in together, making sure that your technology platform can do that reporting for you. And then I think it really does take a lot of work off the advisor.
So one of the cool things about customization is we'll have a client come to us and say, I have 80% of my liquid net worth in Google shares because I work there. And I want to manage that risk, and I want to help you with a tax budget, help me slowly but surely sell this down. And you can create that program with them and crank up or down the tax loss harvesting. But some people also say, I work for Google, I have shares with Google, I don't need that risk anymore. So in the index fund or the rest of my stock portfolio, take Google out of there, or take the whole tech sector out of there, whatever it is, and you can have this customization, which is really, really neat. Where we've had some problems is clients going, oh wow, I can do that? Well, what if I want to take this stock out? And what if I want to take that one out? And I don't really like this CEO. And so how do you set the right guidelines and expectations in place that we're using this customization for good, not so you can pick stocks that you don't like?
We try to have a choose your own adventure approach where there are guidelines around it, right? So when you're doing direct indexing on our platform, it's like, here's your 1, 2, 3. And the idea of that, here are the 3 things that you can do. You can pick US index, you can pick MSCI World, whatever you want to go off of. You can pick a few restrictions, and then you can, you're off to the races. So we've tried to make it, the goal was to simplify for the advisor, but it also simplifies for the client, because they don't have quite quite so many decisions that they have to make. So you get the win-win of it's being easy, and you don't have the client kind of going off the rails. I would say the one other thing I would say to that, because we do get that a lot, like I need to take technology out, right? We actually, when you have custom models and custom UMA solutions, you're actually able to take it out not just of the direct indexing piece, but you can have like a BlackRock, a Goldman, a State Street model, and you can take technology out of that and deliver all of that at scale too. So custom, like I said in the beginning, comes in many different forms, and I think just beyond direct indexing, we can do a lot more when it comes to custom solutions.
Yeah, so with the limitations, the pros and cons of I want to screen out certain securities or screen out certain sectors and industries, it comes down to all the direct indexings, there are algorithms, there's a quantitative process behind all these, and your willingness to take on you or your end clients, that tracking error. So sure, we can take out technology sector, but it's a pretty big chunk of the S&P 500 or the Russell 1000 growth. So if you're willing to take on that, tracking error, that performance risk as well, so it can be accommodated. It's just kind of a tough job where you all have, and Ben, you included, of explaining that to the end client. Like, yeah, I get it. That situation makes sense, but we're going to have a deviation away from the S&P 500 because of this solution. But that's the benefit of this customization, right? That is their choice. You're helping navigate that. You're providing that solution through this direct indexing capabilities.
So when we started, we did direct indexing, and full disclosure, we used Canvas through O'Shaughnessy. It's not at Franklin Templeton. We did it just for the stock side of the portfolio, no fixed income. And I think part of that is the fixed income market's a little harder to crack. It's not nearly as liquid. It's not as easy to trade. But that seems to be something that is growing in the last few years of, wait, we can do this on the fixed income side too, and we can make customized portfolios. If you live in a certain state, we'll kind of match a muni portfolio to you because of where you are, and the customization is coming on that side too. Jen, you talked a little bit about this. Where are we on the fixed income side of things?
On the fixed income side, we're doing it today. So the great thing we can say is that the future that we saw a few years ago is now, right? So we've got, at GeoWealth at least, we're working with different industry leaders in the fixed income side who can take a mandate form, a quick questionnaire, a one-pager, we deliver it to the asset manager, and you're off to the races. So we are doing it in fixed income today. It's exactly what you said. It's around taxes, around where you live, a lot in the muni space, and also advisors that want to manage some duration or different types of yield profiles.
Yeah, at Envestnet, the most popular has been the customization, as you mentioned, Ben, about state-specific. You can also do credit quality duration. But it's just bond ladders. Honestly, it's really simple. I know many of you probably build your own bond ladders, but you can hire a third-party manager to do all the credit research, and then they're going to manage it, construct it, given the customizations at a very low cost, and the efficiency to also use that within a UMA account as well. It's just, again, the scalability, the customization, that you can now have your direct indexing equity sleeve, and then now the fixed income sleeve component as well. It differentiates you versus your peers down the street as well that might have something more off the shelf.
So I always like to say that all the leaps forward that we've seen in fund structures and strategies and technology is wonderful, but behavior is always the final frontier. And you're never going to quite solve human nature, but one of the unintended benefits I think that I've seen from customization with our clients is that if there is some customization to their specific circumstances, there's a little more buy-in there. It's not just a cookie cutter thing off the shelf that you're going to go in one of our 3 models and take it, and that's fine. But I do think that there is a behavioral element to it. So maybe Jen, you can talk a little bit about how these models are actually impacting client behavior and sticking with the plan.
I think you eliminate that, did my advisor just put me in, the wrong off-the-shelf product? You've got something that's been developed for them, for their families, for their goals, with their state and the duration targets in mind. Where I think the behavioral issues or challenges come in is when you put in private markets. So when it comes to fixed income, I think most of our clients know that fixed income is less liquid. They put it in there, they let it manage. I think where we're going to move into needing more education and being more on top of client behaviors is in the private market side, which we could get to a little bit later.
Why don't we get into that now? That's what they always tell me in podcasting. When someone mentions a topic, don't come back to it later, do it right away. So where do private markets fit in this equation?
private markets fit right next to public markets and portfolios today. So I think this is something that we've been trying to get to for, like I said, my entire career. I think what you have now is converging forces that make it really interesting. So you've got public markets at high elevations, you've got a lot of uncertainty with fiscal policy, and you've got clients that are very uncertain and a little bit of anxiety, right? So you've got this whole part of the market that's really not been in private markets before, that it makes a lot of sense to put it right next to your public markets and get clients invested in it. And then you've got those clients that have been with advisors in private markets for years, right? But those advisors are doing the painful nuance one by one private market implementation for those advisors and so for those clients. And so now you kind of have these converging forces of the right time for many clients to get invested in private markets, as well as the advisor population that's doing it hand by hand today, one by one, that wants to do what they've done with models, what they've done with ETFs. We talked about the whole history, and being able to do it efficiently within the same model. So using the UMA technology to be able to do the unicorn, right, which is the ETFs, the direct indexing, the individual fixed income, and the private markets, or at least semi-liquid evergreen markets. And we're there now, which is incredibly exciting on the tech side and on the investment side.
And the good news is the stock market is down 10%, but private equity is flat, never goes down. So one of the things is certain advisors would look at this and go, that's awesome. What about these clients over here that don't need it? Their life is pretty simple. Their circumstances aren't crazy. How do you determine which clients this is right for and which ones it's too much?
Yeah, we have some good data and studies on this too, where, it maybe isn't for all of your clients, right? And that's where the tough job where you have to kind of feel them out. You don't want to get them something cookie cutter, but they need to graduate into something that looks and feels a little bit more high net worth and maybe a little bit more of your time and your team's time. So you can bring it down market. You can customize down to individual mutual fund ETF off-the-shelf models. That is possible to do today. You can do the tax management capabilities, the automated tax management on those capabilities. But it's really comes down to that choice and where you cut that off. Our data kind of, $500K and less account sizes, maybe not worth spending, all your time, your effort to customize, but once you kind of graduate into something a bit more, you can get more separate account exposure, more non-qualified assets. That's where the customizations really kind of take into play. So for us, it's starting around $1 million, our data shows, is like that's where you see much more tax overlay, much more use of direct indexing within client portfolios.
I think it depends on the individual client's liquidity profile, right? Now that you can do custom with public-private at scale, you don't need to worry so much about which client is worth your time, but you do need to make sure, number one, they have the stomach for it, right? We've got this, in the industry, we've given people so much immediate gratification. They can get in and out of ETFs. They can get in and out of stocks so quickly that you need to make sure that these clients understand that although it's semi-liquid, you could get out technically quarterly, these are for the long term. So I think it's about, as the advisor, sitting with the client and really understanding their liquidity profile and when they need investments. And what we've done at GeoWealth to help advisors with that is that when clients do need money, because we know any individual client is going to need money at some point for taxes or a house down payment, we can manage around that in an incredibly scalable way. So you don't need to work on figuring out the semi-liquids. We can do that for you. And we're partnering with providers like BlackRock and Goldman, who are behind the scenes managing the liquidity across an entire book of business for each individual client, which is pretty cool.
I think the other benefit for advisors is most advisors would rather talk about the financial planning side of thing and not necessarily the investments in the markets all the time. And I think direct indexing and customization is a great way to bring it back to the financial plan, right? It's not just the markets and investing. It's what does this have to do with your financial plan, your tax situation, your liquidity, you're selling a business, or you're selling a house this year. How can we actually have your portfolio interact with that? So I think that's the thing that advisors can really circle back on is like, oh, this is actually something that I want to talk about with you, and not just is the market up or what are interest rates doing. And so I think that's one of the big benefits. So I guess the question from here is, okay, we've started this. We've got the zero trades. We've got fixed income now. Like, where do we go from here? What comes next? Brooks, I'll start with you.
Yeah, Jen hit on this a little bit, but talking about privates and alts, of course, topic of the last 18 months and probably topic of the next 2 years as well. But our first phase, or what we believe is go to the next uptick, is advisors using within models is semi-liquids, so use of interval funds within client portfolios. What we have to do at Investet is really allow advisors to scale that within their practice, remove some of that friction so it can be easily accessible. There's all these trading window issues. Part of Envestnet, we need to help solve that for you so you're not bogged down in the operational capabilities. So by the end of this year, we'll provide, according to our tech roadmap, we'll have that capability for advisors to better use that, as well as third-party managers when they build models and sell and distribute on the platform to allow that scalability. And I think also with the interval funds, there's less sub-docs. There's just a better uptick and a easier access to the private markets through that. But Jen, I know you have some comments too.
Yeah, so I think that we are just getting started with custom using semi-private alternatives and public markets all in the same solution. We've got a line of clients waiting to use this. We're actually in market now, and we're able to do it. So, people are RIAs, mid to large size RIAs are starting to step in here, but I think we're just getting started. I think everything from a small RIA up through a super large RIA, as long as it's scalable and they have the right client base for it and they have the time to educate clients on the liquidity profile and understand that. We've got asset managers that we're partnering with, and we're doing this today, removing all those obstacles and all the, frankly, challenges and barriers that have stopped advisors from using semi-private. So everything's pretty streamlined on our platform. We go right into different technology providers that have really lifted the industry. And I think, the rising boat lifts all tides. So the rising tide lifts all boats. So I'm excited for the whole industry being able to do this and the advisors and RIAs that'll help.
Ben, turn on you, like you're much more engaged here. What do you hear from your advisors, your clients? I mean, is there an appetite there for the semi-liquids, or is this more of a lot of talk in our industry, and it's a good solution, right? Like you said, it's going to meet some goals and meet some objectives, but I don't know where I sit if we get it from end client demand yet.
So I came from the institutional side originally, and I worked with the pensions and foundations and endowments. And my initial thought after working with a private book is there's no way this is ever going to work for advisors because all the operational heavy lifting. And so obviously the industry knew that. We can't be chasing clients down for a $5,000 capital call or something. And so you had to make it easier. So the fact that they've done that makes sense. I also think that when you had the college endowments and the pensions have 30 to 40% of their portfolios already in alternatives, it was obvious that the RIA industry was next. They looked at that and said, wait, we have $12 trillion or however big it is. Why would we not go there next? And so I think it's a prime target. But I also think that some of these alternatives are a very easy sell to make to clients. And so I think that there's a lot of different incentives around it, but I think that there is so much talk that clients hear about it too, and I think whether you're using alternatives or not, you have to have a good reason for, yes, we're doing this, or no, we're not. You can't, I don't think it's easy as saying like, no, we'll absolutely never do this, it's too hard. You have to have a good reason because clients are seeing other people using them, and they've talked to other firms that use them, so I think you have to have a story one way or another.
I agree with that. I think if you're not going to use public and private together, and other advisors are starting to do that, your clients hear that from other clients, and they're going to want to know why if they don't.
Yeah, and we've heard from clients too who say, I have $10 million, I have more money than I need or whatever. I know that my plan would probably be fine without these investments, but what if I want this kind of thing? And so I think you have to have a solution ready. So I do think those advisors who have pushed against it and absolutely not, this is not in our ethos, I think you have to have some sort of solution these days.
I will say though, you're right in that it's not for every single client, right? The client that just cannot stomach the markets and is going to knock your door down to get their money out, that's where you do have a problem. And I think making sure they understand the liquidity profile, but I really liked your comment, Ben, that it kind of all comes back to that wealth planning. And since this does have that liquidity component of it, which frankly you should benefit from, you're only going to benefit if you really do stay invested. And I like that within wealth planning, you are talking about liquidity. You are talking about, what are we working towards? What are your goals? And so I think knowing that so many advisors are focused on wealth planning will help them get clients ready for something that's a little bit less liquid.
All right, I think we're just about up for time. I think we have time for maybe one question if we want. Otherwise, I think we have another panel in 5 minutes here. All right, thank you. Thanks, everyone.
Thanks, Ben.
Thank you.